Hi, this is David Skarica, and this is our next podcast, or sorry, video cast on bubble bursting. And what we're also going to show you is, I think there's another thing important about bull markets, is that when a market starts getting hot, everyone wants to chase the returns. One thing I'm going to show you quickly is, this is kind of the philosophy we have at Addicted to Profits, and how to spot cheap sectors, how to spot undervalued assets. I've talked about maximum pessimism investing, and that's actually the name of my hedge fund that I'm about to launch, and looking for cheap equity, looking for cheap ways of doing business, etc. Right? And that's what we're going to try to do in this podcast, is show you that to get returns in the stock market, you don't just have to try to get in the next hot thing or big sector. That actually getting the out of favor sectors and profiting from them can often be the way to go. And actually, even though the downside is perceived to be high, it's actually a lot less downside than, say, trying to buy a hot sector. Like anyone who's, say, buying Yelp or Twitter in the past few months has learned that the hard way. So this is the S&P. And again, let's just look at it just from a graphical form. How much upside is there now in the short to intermediate term, meaning, say, the next 6 to 12 months, after you've had this 5-year rally, which has seen nearly a triple on the market? And look at this ascent to the upside. And what I'm going to show what's really interesting is that even here, even if you had been invested in the S&P during this move here, there are actually a lot of sectors that really outperformed it, that had less downside than the S&P and were less undervalued, especially in 2013 when we had kind of a bubble-ish kind of like move up in the markets. And so the key is, okay, you want to get returns, but I think everyone gets focused. And, you watch Bloomberg or you watch CNBC and you watch the American financial media. All people do is talk about the S&P 500, the S&P 500, et cetera, et cetera. Can you outperform the market? But you can find asset classes which are depressed and can do better. This is the Russell 2000, the same kind of thing. Again, where is the upside, okay, after you have had a 5-year rally where the Russell 2000 has tripled? I personally don't see a huge amount of upside in that kind of trade. Maybe you can go up another 10 or 20%, but to me, the Russell 2000 small caps have, especially when the Fed really begins to move the stimulus, this kind of thing has 40 to 60% downside with very limited upside. So first thing in our newsletter, what we're doing right now is showing people how to hedge yourself. And even if you're bullish on the market, even if you believe in investing in the market for the long term, I think hedges are always appropriate, especially when the market has huge moves like it had. So there's nothing wrong with putting a few percent of your portfolio into one of these inverse ETFs. And the RWM, which for disclosure purposes I own, the short Russell one, this is only short on a 1-to-1 basis, so it doesn't erode like the 2-for-1 short Russells, right? So you can see the RWM, which fell, it's fallen because the Russell has rallied, but, if the Russell 2000, since the Russell 2000 has fallen roughly 6 or 7% from its low, this is up about 7%. So if the Russell 2000 were to fall 30 or 40%, this would essentially rise 30 or 40% and hedge your portfolio. I think even if you're a bull, it's always appropriate to hedge the portfolio a little bit. So let's say you are 90% invested. Well, let's say you have $100,000, you have $90,000 invested. The market loses 20%, so you lose about $20,000 of that $90,000. Well, if the market loses 20%, and you have $10,000 invested in this, it's that $10,000 will go to 12 or 13 or 14,000, depending on how the makeup happens. So that will then protect your hedge. Instead of losing 20%, you lose 15% or you lose 13%. And then you have a collapse like 2008, 2009, where the market loses 50%. Well, again, maybe you only lose 20 to 30% of your portfolio instead of losing 50%. So I think hedges are important, especially when markets get frothy. And we do this in our newsletter and that sort of thing as well, and give recommendations on hedges we see is appropriate. I actually have a trading service as well where we're more aggressive, where we buy put options and things of that nature. So this is the HUI index. So why am I showing gold stocks? Okay, it's not because of being the gold bugs, not because the end of the world is happening. It's because they are actually looking like a sector which is now bottoming. That gold stocks fell 60 or 70% from their highs of 2011, 2012, now are disconnecting from the market. That's really important because from 2003 to 2011, gold and gold stocks were trading with the market. But now they've disconnected again, where they go down and the market goes up, and they crashed basically in the last year where the market went straight up, and now we're showing signs of basing while the market is showing signs of topping. And I think this is important because they can now trade more like they did in the late 90s and 2000. And this is the HUI from 2000 to 2003, essentially during this bear market. And you can see that the HUI, if you had begun to purchase in early 2000 and late 2000 when the market was topping, made anywhere from 200 to 250% in these 3 years, where the S&P lost 24% and actually at its lows lost over 40%. So I think now we're similar to the late 90s and 2000s, where the HUI is actually falling, or the gold stocks are falling while the market is rallying. But once the bear market begins, that the market will roll over, and the gold stocks will actually be a hedge to the market, unlike 2008, and even unlike the late 2000s when they were rallying with the market. So now the gold stocks are again a contrary investment to the market, and they're a good way to do it. And plus, they're beaten up. They're down 70, 80%. They're really, really cheap, and there's some good values in it. So the way I look at the gold stocks too is, and this will show you too how you can outperform by a beaten up sector. In 2012, I became very bullish on Europe and especially Greece. And in the summer of 2012, we began to buy Greece because it was down about 90% from its highs. There was still another drop, which happened in the summer. And you can never time these things perfectly. But what I'm showing you, if you had bought GREC, which is the Greece ETF back in the mid-2012 period, it has climbed 54% since then, where the S&P is only up 34%. So at that time, everyone would have said, stay away from Greece, it's a risky trade, blah, 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 blah. But there was more upside in Greece at that time than the S&P, with more limited downside because the market had fallen so much during that period. Greece was up 95%. Its 10-year trailing PDE was 2 times earnings at that time. So this just shows you, again, you can kind of ignore the market if you can find these undervalued sectors in market, which is kind of what we do in our newsletter. This is, and then not just buying the whole market. What happens if you can actually stock pick? You can find the companies that have more leverage on the upside. We were buying HL Toy at about $1.45 a share, and fell as low as 70 cents. But you can see, since the summer of 2012, where the S&P again is up 34%, HL Toy is up 340%. And again, these are the kind of values that you can get when you use this kind of approach to investing. Another stock we were buying as a European turnaround play was Pris. This is Promotora de Informaciones. It's the largest media company in Spain, and they had to do a debt restructuring, sell off assets, etc. And I figured that they were going to stay solvent. And again, since the middle of 2013, when we were buying this company, it is up 100%, where the S&P is only up 17%. So again, this shows you that by buying these perceived risky assets, which are actually less risky, they've already dropped so much and discounted the bad news, you can outperform the markets. And you don't have to worry about what the S&P does because you're buying cheap assets that are going to outperform once they reflex to the upside. This is First Solar, another perfect example. You can see it crashed in 2011, and we were actually looking at the solar ETF in 2012 after it crashed. And again, you're never going to get the exact bottom. You know, right here at $20 to $30, First Solar looked cheap. They still kept falling to 11. But let's say you had averaged in over this period and you ended up averaging in around $20 to $25 a share. This is up to $66. Again, since mid-2012, when it bottomed, First Solar is way more than outperformed the S&P. Of course, timing is part of it with these things, and you have to be patient and let the bottom play out. But we show you the technical indicators and the fundamental indicators now of which to watch. And again, I would have rather owned First Solar, say, in mid-2012 than the S&P, and it's outperformed since that time a great deal. This is FAN, which is the wind ETF. Again, the wind sector has really outperformed the S&P since mid-2012. Since mid-2012, wind stocks are up over 100%, where the S&P is only up about 30%, about 34%. So again, it just shows you buying a beaten up sector, looking for value in the sector, looking for signs that it's bottoming, basing, can really, really lead to big long-term gains. This is kind of what we do in our newsletter. And this is why, since mid-2012, being invested in Greece, being invested in some beaten up European companies we've been able to outperform the market in a lot of these things, despite the fact that there's been a huge run in the S&P. And then we also try to limit your downside in bear markets or topping.